Is Bitcoin showing signs of final capitulation, or is this still normal market stress? Today, we look at the verified warning signals before market panic becomes obvious.
This is BTC Capitulation Watch. Public videos are released every Monday, Wednesday, and Friday. The full daily reports are available Monday to Friday for subscribers through the link in the description. All right, let's briefly look at our roadmap for today's briefing. We're going to cover the public alert status, check in on systemic actors and infrastructure, review flows, derivatives, and macro events, take a look at stablecoins, run a systemic contagion assessment, and finally, lay out the future risk triggers. Okay, Section 1, Public Alert Status. Let's establish our high-level baseline for current market stress. Today's public status is orange low or moderate watch. Now, I want to be incredibly precise here. This does not mean Bitcoin capitulation is confirmed. It simply means that warning signals are building. We're strictly tracking verified facts here, and while those facts do show material stress, there is absolutely no full systemic capitulation confirmed today. So the current BTC Capitulation Index is sitting in the moderate zone at 45 out of 100. And I need to clarify strongly, this is not a price prediction. It is an indicator-based risk monitoring score built on verified data. We aren't forecasting where Bitcoin is going to trade tomorrow. We're just objectively measuring the internal pressure of the market.
Moving on to Section 2, Systemic Actors and Infrastructure. This is actually the most concerning block of indicators in today's report. Before we get into specific companies, let's look at the weekly direction bias, which is slightly bearish right now, 43% upside versus 57% downside. But immediately clarify this for yourselves. This is not a trading signal. It's just a structural directional bias based on things like technical structure, ETF flows, macro events, and infrastructure stress. Now, let's look at those primary warning signals. We have verified that BitMart is beginning an orderly wind down of its operations. On top of that, BitMEX has actually announced an exchange closure. We're also seeing several Bitcoin Treasury companies selling BTC to repay debt, fund operations, or even pivot toward AI infrastructure. These are material signs of the crypto ecosystem contracting right now.
Section 3, Flows, Derivatives, and Macro. Let's see how capital is reacting to this environment. Spot Bitcoin ETFs just posted 2 large outflow days right before the weekend, totaling about $465 million. That's a pretty substantial capital exit. Now, because this data is still forming, the signal is very much active. If we were to see a third consecutive large outflow day, well, that would be a much more serious warning signal for us. Shifting over to derivatives, things remain in a medium risk area. The good news is our report does not confirm a market-wide liquidation cascade at this time. Now, if BTC were to lose key support and liquidations started accelerating, risk would obviously rise. But right now, that cascade just isn't confirmed. On the macroeconomic front, this week's Fed meeting is a major volatility event. You know how Fed communication goes, it always injects volatility. Also, keep an eye on the Clarity Act. Regulatory clarity could really support crypto markets, but any delays or restrictive provisions could create some serious headline risk. Section 4, Stablecoins. After all that stress data, let's take a look at the most reassuring signal we have today. Major stablecoins remain incredibly resilient. There is absolutely no verified sustained depeg in USDT, USDC, DAI, or FDUSD. Now, you might have heard about balance coin collapsing. While true, it's important to note that it was a small algorithmic stablecoin hit by an Oracle exploit. It just highlights that Oracle-based DeFi systems are vulnerable, but this is definitely not systemic stablecoin contagion. The majors are perfectly fine. Section 5, Systemic Contagion Assessment. Let's zoom out and put this all into perspective. To really understand today's environment, we have to compare it to past cycles. What we're seeing right now is not confirmed contagion like we saw with FTX, Terra/Luna, Celsius, Three Arrows Capital, or MTGOX. The events today, the ETF outflows, exchange wind-downs, Treasury selling, and Fed risk, look a lot more like early cycle contraction rather than widespread systemic insolvency. And finally, Section 6, Future Risk Triggers. Let's look at the balance of risks. Let's objectively weigh the forces acting on the market right now. What increased our risk score? Well, the BitMart and BitMEX news, the Treasury companies selling, those 2 strong ETF outflow days, the looming Fed risk, and the localized balance coin collapse. But what reduced risk and kept us out of the red zone? Major stablecoins are stable, there is zero confirmed general withdrawal freeze, no verified Tether or Circle redemption issues, no liquidation cascade, and critically, BTC hasn't decisively broken below $64,000.
So what specific triggers could shift our index higher in the next report? Here's exactly what to watch. A third strong ETF outflow day, BTC losing $64,000 paired with liquidations, new Treasury company BTC sales under stress, any withdrawal restrictions popping up at an exchange, a major stablecoin depeg, or a hawkish surprise from the Fed.
The goal is not to predict Bitcoin's price. The goal is to monitor whether real stress is building before it becomes obvious. This public recap is only a summary. If you want the full BTC Capitulation Watch report Monday to Friday, use the link in the description. Educational content only, not financial advice.